What is depreciation? How does it work? Why we have overall the depreciation, or how we are recording that in the accounting system? If you would like to know more, stay with us till end of the video. Hi, this is Milad Akbari. Welcome to Akbari Education. Here we're gonna discuss about finance, accountancy, entrepreneurship, and whatsoever will end up to your independency and success. Today's video, we are going to cover depreciation risk. Let's directly jump to the content of the video. What we have here is, what is depreciation? Depreciation journal entry. Why overall depreciation is there, or what does it mean? What is residual value terminology? Depreciation cash effects, example, and a practice question related to depreciation. Let's continue to that. What is depreciation? Depreciation is an accounting method to allocate the cost of tangible asset over its useful life. The cost of tangible asset over its useful life. We have purchased a computer for $5,000 and we are allocating that for 5 years of useful life. This process is called depreciation. It represents how much of an asset value has been used. We have purchased this and we expect the useful life to be 5 years. When we use for 1 year, how much of the value has been used during that 1 year? That's called depreciation. In continuation, depreciation allows company, this is very important sentence, remember, depreciation allows companies to write off and spread out the cost of an asset over time and match depreciation expense to related revenues in the same reporting period, which is called matching principle. Matching principle says that whenever you are earning cash, earning revenue, or you have a revenue during a period, the expense which caused that revenue to be generated, it should be recorded or reported overall in the same reporting period. So when I purchase a computer for 5 years and I paid 5,000 in the initial year and I'm using it for 5 consecutive years, then why, in simple word, it is generating income for me during that 5 years. Why I'm recording that only in 1 year? Matching principle says that when this computer is utilized to earn revenue during 5 years, the expense of that should be recorded in that 5 year. But this process is not possible in simple words because we are allocating that. We record that cost as an asset in the initial year. The process of allocating of that cost or portioning of that cost from the balance sheet to the income statement during this 5 year is called the depreciation. Come to the second sentence. Companies take depreciation regularly so they can move their assets from asset cost from the balance sheet to their income statement. It means I have $5,000 here and I'm trying to use that for 5 years. So the 1,000 for 1 year, which will be transferred from the balance sheet to the income statement, is called depreciation. It is a write-off. It is spread out the cost of an asset during the period we are using that asset. So there are many types of depreciations, but we are going to cover most important ones in future videos, individual, by example, and practice questions. But for here, just remember that there are many types of depreciation methods, and overall the depreciation, the general idea behind the depreciation. Here is a test your understanding for your practice purpose. Please insert your response as a comment below to the video. Let's go ahead. The journal entry is almost similar in all, I can say to you, but how it's recorded in the accounting system is by debiting and crediting. If you don't know about debit and credit, there is a very good video in our channel by name of debit and credit, the secret behind debit and credit. Go and review that. It will be beneficial for you. But overall, in one side we have the balance sheet, and other side we have the income statement. In one side we need we have recorded an asset, and now we are going to record an expense. So the depreciation expense is here, and it is recorded in income statement. But how? By debiting. What we are doing is the depreciation expense should be debited. This is what we are going to do. And on the other side, there is something else, which is called accumulated depreciation. This is a contra account to asset value. What does it mean? I will come to that. This will go to the balance sheet. It is a balance sheet item. But how it's recorded? In either side of the journal entry, we will have a credit entry, which is to accumulated depreciation. So accumulated depreciation will be credited. Suppose we have that 5,000 asset, you remember, yeah? It is 1,000 each year. So what we are going to do is 1,000 debit to the expense, which is depreciation expense, and it goes to income statement. And there is 1,000 credit to accumulated expense, which is, accumulated depreciation, which is go to the balance sheet. How it is presented within the balance sheet, come to here. Suppose we have purchased that computer for $5,000, and after 2 years, we have allocated $1,000 as depreciation expense to that asset, to the income statement. And now we have an accumulated depreciation value of around about 2,000 by end of second year. So the net balance, the net value of asset is the 3,000. It is a very generic, clear idea. I use that asset for 2 years. Then my net value is not still the 5,000. It is 3,000. And that 3,000 will be reported in the financial statement. And if you don't know about the financial statement very well, there's a video there in our YouTube channel as the name of Financial Statement and Elements. Go ahead and review that. Let's go ahead. But why are assets depreciated over time? A reason behind. If you remember, I told you about the matching principle. When I generate income, the expense which incurred to generate this revenue should be recorded in the same period. That's a reason. But let's go ahead. New assets are typically more valuable than older ones. Okay, I purchased a mobile phone. Next year, there is a new generation coming. So the older version will have a value of lower, the value is lower amount than the newer one. So this is a reason we need to depreciate the value. Depreciation measures the value an asset loses over time. What does it mean? Or how? I'm using a mobile phone. It will lose its value. It will be depreciated. It will be tear over the period of time. It may become old. I'm using that. That's why the depreciation is needed. And the depreciation can be directly from ongoing usage. The reason behind can be because I'm using it is a reason for the depreciation. Indirectly from introduction of new product models, new model come, new version come, and the old version deteriorated in its value, or other factors such as inflation, even such as upsides and downside in supplies of the raw material of that, and many other macroeconomic factors can affect also. So that's why, in simple word, it's good to have depreciation beside the matching principle concept that I have told you. Let's continue. What's residual value? Residual value, other name given to that is salvage value. It's mostly interchangeably used between the IFRS, International Financial Reporting Standard, and GAAP, Generally Accepted Accounting Principle of the USA. So they are interchangeably used, and whenever you see them in different places, remember they are the similar thing. Okay, this is the amount that the asset is expected to be worth at the end of its useful life after accounting for depreciation. I purchased a computer, and I'm sure even after 5 years, it will worth $100. That's the amount we are recording or considering as a residual value at the end of the period. This is estimation, remember that. This is estimation. That's why it's called residual value at the end of the period. It is useful during calculation of the depreciation. How? Stay with us for the next and future videos. We're gonna cover that in very detail. Here is a test your understanding for your practice purpose. Please insert your response as a comment below to the video. Let's continue. Depreciation cash effects. Is there any cash effect with the depreciation recording during the period? Let's see. Depreciation is considered a non-cash charge because it doesn't represent an actual cash outflow. What happened is that we are allocating a portion of the asset purchase, and the cost is recorded in the initial cash outflow was in the initial stage. We are recording a portion of that in the income statement without any cash outflow. That's why there is no cash outflow during the period for the depreciation. The entire cash outlay might be paid initially when an asset is purchased. When we purchase that, we are paying for that. Maybe an installment, but it is in cash flow outflow, which is at the beginning of the purchase. It is the outflow, which is mostly recorded as a capital expenditure, term capital expenditure and revenue expenditure. There is a video, go for that. But the expense is recorded during many periods for financial reporting purpose. Why? The matching principle. We are earning revenue, that's why we are recording that as a depreciation, which is initially paid as an asset. That's because assets provide a benefit to the company over a lengthy period of time. We are benefiting that while we are using that to generate the income. Here is a test your understanding for your practice purpose. Please insert your response as a comment below to the video. In continuation, there is an example. Let's assume that a company buys a piece of equipment for $50,000. Life of the asset or useful life is 10 years. Calculate the depreciation and record the journal entry. We have purchased this asset for $50,000 and we are trying to use that for 10 years. So each year will be 5,000 to allocate from the asset to income statement as a depreciation. The journal entry, if you remember, it was debiting the depreciation expense by 5,000 will be debited. It's a debit entry. And the accumulated depreciation, which is a contra account against the asset value, accumulated depreciation will be 5,000. A crucial part to remember, this 5,000 is expense, it's going to income statement, but this 5,000 will be kept and accumulated during the years which the depreciation is charged. This is the journal entry. Let's go ahead. What is the purpose of charging depreciation? Overall, I have discussed that, and if you have any idea, put that in the comment if you have any idea about why overall we are charging the depreciation. The first one, to allocate the cost less residual value of a non-current asset over the accounting period expected to benefit from its use. Remember, in a straight line method, we are decreasing the residual value from the value of the asset, and we are recording that at the top for the calculation of the depreciation. We will come to that in separate video. But the cost less residual value of a non-current asset over the accounting period expected to benefit from its use, to ensure that funds are available for the eventual replacement of the assets, to reduce the cost of the asset in the statement of financial position to its estimated market value, and to comply with the consistency principle. Pause the video, focus on that, and come back to me. Let's continue. The last one, to comply with the principle. Which principle? Matching principle. It's not the term. To reduce the cost of assets in the statement of financial position to its market, yeah, we are reducing the cost. We are transferring the cost to the accumulated depreciation, but it is not exactly the market value. It is not matching that. And the purpose is not to decrease the cost, but accumulate the depreciation expense in an account, a contra account, which is called accumulated depreciation. To ensure that funds are available for eventual replacement, we have already paid for that. And when we are receiving the revenue, it's going to be accumulated to purchase a new asset. Why we are in need to record the depreciation on such a condition. So we will have the amount for that from the revenue. This is not the reason, but the best one, the best option is to allocate the cost less the residual value of a non-current asset or a fixed asset or a tangible asset in our term over the accounting periods expected to benefit from its use. We are using that. We are allocating a portion of that cost to the income statement. The term here, let me remind you here. For the cost, suppose it was $5,000, and you remember I said, suppose we are selling the computer for $100 at the end of the period. That's why the residual value will be deducted, and it will be divided by the period we are using, 10 years or 5 years, whatsoever we have estimated the useful life. Thank you so much for being with us. I would love to hear if you enjoyed the video, and I wish it was enjoyable, it was beneficial for you. Kindly remember to subscribe to the channel, like for future videos. Thank you, appreciate that. Bye-bye.